Hi, I'm Jonathan Treussard, and welcome to Treussard Talks, where we talk about the mechanics of investing, the psychology of investing, and what it means to manage your wealth with purpose. Because understanding your wealth shouldn't be as complex as building it. Welcome to today's show. Michael Imerman, delighted to have you on the show today. You are a professor of finance at the University of California in Irvine, and you are the author of a brand new book called The Economics of FinTech. What is FinTech?
It's one of those things that's kind of easy to define in a sense that it's just a contraction of the words financial technology, right? You take the fin from financial, you take the tech from technology, you smush it together. In that respect, it's very easy to define. Where the nuances come in when you look at a particular product or service and you ask yourself, is this fintech, for example, Apple Pay or PayPal or AWS, Amazon Web Services and cloud computing? Are these fintech innovations or just general technological innovations that have applications to finance? That's where it becomes a little more challenging. So the objective of the first part of the book is to tease out exactly what fintech is. The book is organized into three different parts. Part one is laying this conceptual framework and foundation for understanding fintech and its implications for the economics of financial intermediation. Fintech refers to this newer phenomenon that we've witnessed just over the past 15 years. This is what we call in the book the fintech revolution, where technology firms that traditionally have had nothing to do with financial services like e-commerce platforms, data analytics companies, mobile computing, cloud computing, hardware, software, all of these tech companies realized that there are very profound demand for these technological driven and data-driven services in finance. And so over the past 15 years, they've kind of moved into the space that was traditionally occupied by asset managers, banks, insurance companies, providing similar services, but in a data-driven, tech-driven format. So another question I get all the time is, well, haven't banks and asset managers always used technology? And the answer is yes. I mean, you can go back to the ATM, you can go back to computing and database management and stuff like that. But what's very different over the past 15 years is that it's no longer the incumbent financial service companies that are necessarily relying on these service providers for their technology, but it's actually the technology providers that have moved in and are actually meeting that demand from consumers and businesses for these financial products that traditionally were developed by the incumbent financial institutions.
Got it. So as with all forms of innovation, I guess there is the incremental version and, of course, the quantum leap version of this. And it sounds like what you're saying is the technology companies have realized over the last decade or so that they have a role to play, that they have an edge in addressing both these incremental changes and these bigger picture improvements. Where is the action right now? Where is the edge of where finance problems need technological solutions?
You know, all the rage right now is with AI. So, another thing that we established in the book to kind of explain fintech innovation and the economics of fintech, and we do this very early on. This is in chapter 1. It's figure 1.1 in the book. Is we develop a fintech ecosystem. And this actually predates my even writing the book or even the book proposal. This goes back to when I was doing consulting, and that's how I got into the fintech space. My background is, like you, Jonathan, I've got a Ph.D. in finance and economics. I did a postdoc in financial data science. I spent the next 6 years of my career as a tenure track professor at Lehigh University trying to bring those two areas together. Fintech just kind of fell in my lap. And at the time, we're going back like a decade, there was no academic interest. There were no conferences. There were no special issues of journals. There were no journals. There were no majors, minors, programs. The way I got into fintech was providing executive training and consulting to asset managers, banks, commercial banks, community banks alike, insurance companies, on how to remain competitive. We're going back about 10 years, and according to the book, based on data that we've collected and analyzed, the fintech revolution really started 15 years ago, right after the global financial crisis. One of the things we say in the book, and I often use in my lectures, is that FinTech rose from the ashes of the global financial crisis. The number one question I got, and still get to this day, is the first question you asked me, Jonathan, which is, what is FinTech? The other question I got was, is this FinTech? Is that FinTech? Where's the innovation occurring? I came up with this FinTech ecosystem that I use to kind of visualize where the innovations are occurring. And it's organized into FinTech verticals, which are different subsectors within financial services, ranging from payments all the way to real estate and insurance. The way it's organized in the FinTech ecosystem is from oldest to newest. Some of the oldest technological innovations in financial services are actually in payment processing. And so payments is all the way on the left. The newer innovations are occurring in the real estate and insurance spaces, what we call PropTech and InsurTech, respectively. And then in the middle, you've got things like digital banking and FinTech lending and digital wealth management and so on and so forth, right? So those are the FinTech verticals. Then we've got FinTech horizontals, which span all of these FinTech verticals. And those include functional areas that have experienced digital transformation, like risk management and valuation and regulation. All of these have had to adopt and adapt. And they had to adopt new technologies, and they had to adapt to the innovation and transformation that's occurred. And then you've got the emerging technologies that are touching on each and every one of these verticals. And those include things like distributed ledger and blockchain technology, cloud computing, AI, quantum computing. So I would say right now, where we're at 2025, all the rage is around AI. And that's no surprise. I mean, we've been seeing this ever since ChatGPT was released almost 2 years ago. Any kind of application of artificial intelligence to finance, whether it's in banking, whether it's in lending, whether it's in insurance, whether it's in wealth management, is getting a lot of attention right now. Now, if you were to ask me where we're going, what really excites me is the potential application of quantum computing to finance. And I think that's where the next big leap is going to be made. No pun intended, quantum leap, right? We should all be looking at the potential applications of quantum computing, because quantum computers are going to be commercially available over the next 5 to 10 years. And so that's what really excites me right now.
So let's go back to the prehistoric days of the global financial crisis. You said FinTech rose from the ashes of the financial crisis. And I was there, you were there. But for the sake of communal understanding, what do you mean by that?
Right. So if we go back, like you said, to the prehistoric days, we're dating ourselves here. You go back to 2005, 2006, 2007. There was this buildup of risk in a financial system. This is something I lecture on quite frequently. Actually, the class I'm teaching right now at UCI is a financial innovation class, and it's all framed within the context of innovation cycles. Also, a conceptual framework that Frank Fabozzi and I developed in the book, where basically innovation occurs in waves. The timing of the wave is very unpredictable, but the sequencing of it is very predictable, right? You've got a buildup of innovation, you've got a lot of excitement, you've got a lot of hype. It peaks, then something happens, whether it's some kind of exogenous shock or some type of endogenous shock that results from misuse of the innovation. And then, we have some fallout from that. Quite often it's a crisis. And then there's a regulatory response. The regulators tend to overreact and overregulate, and innovation moves to a new part of the economy, and the cycle repeats. If we go back to 2005, 2006, 2007, there was this buildup of risk in the economy. Interest rates were historically low. Underwriting standards for mortgages were relaxed tremendously. You had people being approved for loans that shouldn't have, with 0% down. You had all these funky mortgages with features like balloon payments or negative amortization. You had interest-only loans where basically you're just paying interest and the principal was just sitting there. This risk was then sold off to investors in the form of mortgage-backed securities. The mortgage originators didn't care about the riskiness of the loans, because there was this business model, what we referred to as originate to distribute, where these mortgages were being securitized, they were being packaged into bonds, sold off to investors, and it became the investor's problem, right? What happened then? Real estate prices started to decline. Those borrowers that should not have been approved for loans and were told, oh, don't worry about it. Your house is only going to appreciate in value. So worst case scenario in the future, you take equity out of that house if you can't afford your monthly payments. Now that became a problem. My house was worth $400,000. Now it's worth $300,000 and I couldn't afford it in the first place. Now I've got negative equity, right? The value of my house is less than the value of my mortgage, and I can't afford my monthly payments to begin with. And then you've got all those funky features I was talking about, interest only or balloon payments or negative amortization and teaser rates, adjustable rate mortgages that escalated after X number of years, right? And we started seeing interest rates come up again. So people had that additional pressure of being unable to make their monthly payments. And so long story short, what started as a dip in real estate prices combined with exogenous shock was these macroeconomic factors. Real estate prices started to come down, interest rates were going up. The endogenous feature here was the fact that there was this systemic risk being shed off to investors. And so there was this distortion or perversion in incentives from the lenders, as predicted by the theory of innovation cycles that we came up with. There's a combination of an endogenous and exogenous shock that implodes the market. What started as a simple dip in real estate prices escalated into a subprime mortgage crisis where these subprime mortgages were defaulting in mass. That then made its way into the capital markets through these mortgage-backed securities. So we saw a full-blown financial crisis, which ultimately led to the global financial crisis, or the GFC. Now, getting into where FinTech comes in, again, as the innovation cycle predicts, is regulators respond. They want to save face. They want to make it look like they're doing something. So they come out guns ablaze and are trying to overregulate. But the problem is, and we talked about this a lot when I was at the San Francisco Fed in 2022 as a visiting scholar, is that regulators are often regulating in the rearview mirror. They're looking at the last crisis rather than looking out the windshield at the next crisis. This is what we tried to do at the San Francisco Fed. I was in a dedicated FinTech group. So we were tasked with anticipating the risks that arise from these emerging technologies as they're being applied to the banking system. What are the risks of these emerging technologies? There are certainly opportunities, so we had to balance the risks and the opportunities. So, I was very proud to be a part of this internal think tank at the Federal Reserve Bank of San Francisco because we were actually looking out the windshield.
I think that's the fundamental point you're making. FinTech can be described as a moment of awareness where the technology companies have a set of tools and knowledge base that can be applied to finance in a new and improving kind of way. But I think what you're describing is the cycle of innovation is truly a cycle of crisis and regulation, where in a lot of ways, when we regulate legacy financial entities excessively, when you're telling a bunch of people and a bunch of entities like banks, hey, don't do this thing, then this thing's going to get done somewhere else, right? How do you think about that? If you think about the move into this FinTech revolution, are you able to assess how much of this action is just the fact that the technology players have an edge, kind of in a absolute sense, and how much of it is regulatory arbitrage?
Yeah, I mean, it's definitely a combination of it. So what happened, the way that FinTech rose from the ashes of the global financial crisis is, as you said, these activities are going to get done one way or another. So with the regulators coming out and saying, you can't do this, you can't do that, and the banks were kind of in risk-off mode. The banks, the broker-dealers, the asset managers, they were in risk-off mode. So they're pulling out of the market. They're pulling out of the market. And the tech companies, this just so happened to be at a time where what the World Economic Forum calls the fourth industrial revolution, where we've got these new technologies, Internet of Things, right? We've got wearable devices. We're being tracked. All of our activities are being tracked. We're all using mobile devices. Same thing. These all have sensors in them and are collecting data in real time every instant. Storage is cheap now, right? We've got cloud computing. We're not using hardware that's on the premises anymore. And then you've got AI and big data analytics that came to the forefront right around this time. I mean, this is when I did my postdoc in 2011, 2012, right at the beginning of this FinTech revolution. It's not a coincidence. So I did my postdoc in big data analytics. Actually, it was high-dimensional statistical inference and learning. That's what the NSF grant was. It's a fancy way of saying big data analytics in finance. These activities are going to get done, right? And this gets to the economics of FinTech and how technology has changed the economics of financial intermediation, right? You've got those companies, businesses, organizations, and households that have money and don't need it right now. And then on the other side of that, you've got companies, businesses, organizations, and households that don't have money but need it right now. And so instead of a traditional financial intermediary acting as the middle person in this transaction, now you've got technology platforms. It was just kind of this perfect storm of the traditional financial institutions referred to as the incumbents pulling out of the market because they're in risk-off mode. And they're like, we're not going to underwrite as many loans anymore. And we're only going to underwrite the most pristine borrowers' loans. technology platforms come to market, you've got investors that lost confidence in their brokers, in their asset managers, in the investment companies to whom they entrusted their wealth. So there was also a crisis of confidence here where the consumers were also kind of pulling back and they're saying, I don't really like what happened in my brokerage account over the last 18 months. I'm going to look for other sources of return. And then so you've got a technology platform like a peer-to-peer lender that has this novel business model that says, you know what, you've got money and you don't want to just put it in a bank account and get 1%. You want to get 10% or 15%. This person over here needs a loan and they can't get a loan from a bank anymore because the banks have gotten much more stringent with their underwriting standards. Maybe they took a hit during the global financial crisis. Their credit score is not very good. Over here, we've got a person that needs a loan. Over here, we've got investors or savers that want to put their money to work. So let's come up with a technology platform and let's match them. And that gave birth to peer-to-peer lending. We saw a lot of these types of innovations come to market just in that period of time, right after the global financial crisis, because it was this perfect storm of the incumbents pulling out, being in risk-off mode, this crisis of confidence where consumers were like, I don't really trust my bank anymore. I don't really trust my broker anymore, but I still want to put my money to work. And then you've got other people that are looking for credit and can't get it. These new technologies came to market at just the right time to provide a new solution to an old problem.
Yeah, and that's where I tend to worry at the margin. Look, I understand the world changes. That's the nature of evolution. But a crisis of trust, a crisis of faith in legacy institutions doesn't necessarily mean that the thing that emerges deserves your trust in a superior form relative to the thing that you've just lost trust in. But setting that aside for a minute, one of the things you said, or at least my interpretation of it, which I think is really important, is if you ground yourself in this functional vision, which is, hey, we have a handful of things that need to happen, intermediation, and the most fundamental of them all is, on the one hand, we've got people with resources and limited use for those resources. And on the other side of the equation, we have, let's just call them entrepreneurs and whatever, just parties that could really make a dent if they had those resources. That's the fundamental intermediation of finance. If you ground yourself in those functions, then you apply the tools to achieve better outcomes, as opposed to what I suspect you see a lot of as a student of FinTech, which is a tool in search of an application where it's just like a bunch of features, but you're like, great, I'm happy for you, but this isn't a thing that we need to solve. So how much of that do you see out there, and what are the biggest misconceptions of where FinTech is truly adding value? And maybe one of the greatest, I'm going to put it in simple terms, what's the biggest myth in FinTech today?
The biggest myth in FinTech? I'm not sure I would position this as a myth per se, but I think you really hit the nail on the head where a lot of what we've seen in recent years are solutions in search of a problem. And that's a term I've seen used increasingly with blockchain and distributed ledger technologies. If we go back to the birth of the FinTech revolution right after the global financial crisis, blockchain technology was very much in its infancy. The research behind it, distributed ledger technology, really goes back to the 1980s. But the application of it to finance, for example, with crypto assets, you'll never hear me use the term cryptocurrency. It's not a currency. And it does not fit the definition of a currency, right? It's not a store of value. It's not a generally accepted medium of exchange, right? I can't go to Starbucks and go buy my cold brew using Bitcoin or Ethereum. I'm sorry to all the crypto heads out there that might watch your podcast, but it's not a currency, but it is a digital asset, right? So you saw an application of this distributed ledger technology for a decentralized financial system, an alternative financial system that didn't rely on banks, didn't rely on central banks. And that's concerning for a whole nother set of reasons. But that was one of the first use cases of distributed ledger technology and blockchain specifically to finance. And that also just emerged the same time. Then we go into the whole hype cycle of new innovations. It did kind of reach its peak, I think, just before COVID. And that's when you had all these NFT, meme coin, and all those types of speculative investments that were very, very hot. And part of it was, then COVID hit and people had nothing else to do. And so what did we do? We made memes of like apes and they traded at thousands of dollars. And you had meme coins that are named after celebrities and farts and all sorts of silly things, right? I think recently now in that hype cycle, we've kind of reached that trough of disillusionment where now everybody is questioning, well, what's so unique about blockchain? How's it any different than just a network of spreadsheets or just decentralized databases, right? Where you've got your database, I've got my database, and we just reconcile it, or we have an independent third-party reconciler. Essentially, that's what blockchain technology is doing. So I think now we've kind of entered that trough of disillusionment in the hype cycle, where people are really questioning the application of this and how novel is it to existing methods that we've used. And then ultimately, we'll come out of that disillusionment and plateau, and we'll have this period of enlightenment where people realize, okay, this is a little different, and it has some really interesting use cases. One that excites me, and back to my time on Wall Street, I'm a fixed income guy, right? So secured lending is, I think, a really interesting application of blockchain technology and more generally distributed ledger technology, because if I've got a loan that's backed by collateral, but then I repledge that collateral elsewhere, how does my lender know that I repledge that if it is published in a centralized database that we all have access to, right? So I've edited it on my end. It's been validated by a third party, and you can see it on your end. Oh, Michael just repledged that collateral that he pledged to us. That's a red flag, right? So I see that as a potential really exciting application of blockchain technology. But the term that's been thrown around in recent years, is blockchain really a solution looking for a problem? You have these new technologies. Is it just the shiny new thing that everybody's excited about and we're looking for ways to apply it? Or does it really do something differently that our existing methods and infrastructure can't do?
Thanks for listening. I'm Jonathan Treussard, founder of Treussard Capital Management. I hope you're enjoying this episode. If you'd like to start receiving my free newsletter, Wealth Empowered, or if you'd like to learn more about me and Treussard Capital Management, go to Treussard.com. That's TREUSSARD.com. Thanks, and enjoy the rest of the episode. I think yours is a very good one. Anything you can do that creates more light and disclosure and prevents the misuse of resources and assets, let's just call it what it is, limiting fraud, tends to be a good idea. Now, people will push back on it because we seem to have, as a species, a mild preference for keeping certain things in dark corners and playing games with each other. But I think you're right. The concept of a readily available ledger that kind of tells us, hey, this one asset has been pledged over here. If you try to pledge it over there, it's going to go up the flagpole. That seems net positive. Though I suspect a lot of people would say, well, I kind of like the world in which I could pledge the asset three different places. But it's too bad for them. The thing that, and again, you're a student of this in a way that I'm not, we're going to set aside the concept of a cryptocurrency and even a crypto asset for a minute. But when it comes to these networks, Ethereum and all of that, my understanding of what's going on is really that this is unregulated security issuance, where the tokens are the securities. I guess my functional version of it is, hey, you invent a network that is supposed to do something of value. You issue basically shares against it. Those are the tokens. Now, you get to do that in a reasonably unregulated manner, which is part of the thing that concerns me. And you say, for those people that actually hold the tokens, those are credits to use the machine. And tell me if I'm missing something, but I haven't seen those machines do very much of societal value at this point.
And I mean, that's why we do touch on this in the book, even though this is a very rapidly evolving area, as are all the parts of the fintech ecosystem, right? So, the one question I often get now that the book is out, published in April of 2025, But I'd been working on it for 6 years. This summer is 6 years that Fabozzi and I started writing the book. And so a question I often get is, why did it take you so damn long? And that's a very good question. Part of it, though, is the fact that this is such a rapidly evolving area. So unlike writing a macroeconomics textbook or an investments textbook, FinTech as an academic area of inquiry is exciting, but it's also challenging as an academic researcher because it's moving so quickly. And it's not like a blog post where you could just put it up today, take it down tomorrow, rewrite it. We had these chapters that were revised 30, 40, 50 times, literally. All of the areas within the FinTech ecosystem were evolving so rapidly, especially during COVID, because COVID provided a tailwind to the adoption of many of these new technologies, mobile payments being a great case in point, right? So when you look at crypto assets, that's kind of the intersection of the FinTech horizontal of blockchain and distributed ledger technology and the FinTech vertical of capital markets. It's a very small part of the FinTech ecosystem. When I taught FinTech at the Claremont colleges, where I was before UC Irvine, one of the students once wrote on my teaching evaluation that Professor Imerman didn't spend a lot of time on cryptocurrencies, which first of all, that was a trigger because it's not a currency. And second of all, they then went on to say this is arguably the most important part of FinTech. And I would argue otherwise. If you look at the visualization of the FinTech ecosystem, it's literally a dot on it. So there's so many other innovations that are going on, but it's not to say it's an unimportant dot on the FinTech ecosystem because it definitely has changed.
Well, it's certainly
exactly. It's changed the whole narrative of investing and asset allocation, right? This is a type of alternative asset class. We call it digital assets because it's not a currency. What are the diversification benefits of this? What is the microstructure? There's so many areas that need to be better understood as a financial economist. But the way we define it in the book is it's a speculative commodity.
That's exactly right. You're in good company. My good friend, David Noddick, describes it as a psychological commodity. But I love what you just said about let's zoom out and not just look at the one dot that's getting a lot of attention, because if you actually are an economist and you care about societal outcomes and improving the efficiency of the system, what you're saying is FinTech is huge in scope, vertical and horizontal. And I guess if done right, it can help expand access to capital markets, or at least the capital functions. It can lower the costs, including the costs of surveillance, right? Your description of not pledging the asset 3 different times, which presumably allows for more efficient lending, and then reduces inequality, right? Because in this disintermediated world, maybe, just maybe, some of those human biases that are hardwired into the old ways can be sidestepped. So is that a reasonable description of what you're saying?
I mean, cost is definitely one facet. Another one that I'm glad you brought up is access and inclusion. So that's something that we spent a lot of time thinking about when I was at the Federal Reserve Bank of San Francisco. And a lot of these new technologies are targeting underserved markets. And these are individuals or households or even businesses that have traditionally been excluded from the mainstream financial system for a whole host of reasons. It could be that they don't have a credit score, they have a thin credit file, or just the particular neighborhood they live in is not targeted by the incumbent financial institutions because it's not a high margin demographic, right? So a lot of the FinTech innovations and the innovators, the individual companies and the products that they've developed are targeting these underserved markets, which is really exciting from an access and inclusion perspective. Now, the flip side of that, though, is what are the hidden risks there? So that's another thing that we were tasked with examining when I was at the Federal Reserve Bank of San Francisco. Is it's great to look at the opportunities and the benefits, and that's certainly something that we advocated for. But you've also got to consider the hidden risks that are lurking. So one example is in FinTech lending. The new technologies that have arisen out of the FinTech revolution allow for the use of alternative data in analyzing the creditworthiness of a borrower, right? So if you've got a borrower that has a low FICO score just because a younger version of themselves screwed up, they maxed out their credit card, buying a whole new wardrobe, didn't realize they have to make the monthly payments. I see that with my undergraduates sometimes. They're like, oh, I just got an email saying I've been pre-approved for $20,000 credit. They don't realize you got to make those monthly payments or you're setting yourself up for a lifetime of financial hardship, right? Or maybe you're an immigrant. You move to this country and you're starting from scratch and you don't have a FICO score, but you have means, right? You're an upper middle class household, but you just don't have a FICO score. So how do you get access to credit? Well, there are other data points that can be used beyond the FICO score to evaluate the credit worthiness of a borrower. And that's where alternative data comes in, and analyzing that data using these new technologies, namely artificial intelligence and big data analytics. FinTech lenders will use this alternative data to be able to make real-time credit decisions. So that's the other benefit of this, is instead of taking weeks or months to approve a loan, you can get it instantly. But there are risks associated with using this alternative data that we're first now starting to understand. For example, some of the alternative data that's used could be proxies for protected characteristics, right? Lenders cannot make decisions based on gender or sexual orientation or race. And even though they're not explicitly using that in our models, they don't have a variable or a feature in our model that says, gender or sexual orientation or race. That would be a blatant violation of fairness and lending laws. But it's possible that if they're using, for example, what magazines you subscribe to digitally, right? Who actually gets paper magazines anymore? But, digitally through your iPhone or your Android, you subscribe to certain magazines. And if you're making those payments on time, it's automatically withdrawn from your account. That shows financial discipline, and that's valuable information. But what you subscribe to as a consumer, the products that you purchase on Amazon or the shows that you watch on Netflix, are going to say something about you and could be proxies for these protected characteristics. And this is a gray area that the regulators are really struggling with.
Yeah, I think it's a great struggle, right? You're trying to improve efficiency and the way things are done. And as much as people have a tendency to discount the value of regulation, the moment you step out of the system, then all sorts of things can happen that are very explicitly prevented within the system. And that's the reality that we're facing. Look, I really think you're helping everybody understand what FinTech is about in a much more holistic, complete way beyond the caricature, which is desperately needed. But let's go back for a minute, if you don't mind. You teach in a university setting at a business school. I know you're so committed to your students and you're passionate about teaching. What are some of the things that when you're teaching a concept to undergrads or graduate students at UCI, and you see that moment of realization, this makes sense, this is important, how does that play out for you?
I mean, that's what gives purpose to what I do. So, when people ask what gets me out of bed in the morning, because I do a lot of things, I wear a lot of hats. I mean, I'm a husband, I'm a dad, I'm a consultant, I'm an advisor, I'm an editor-in-chief of a journal, I'm an author, I'm a basketball coach. I wear many different hats, but what gets me out of bed in the morning is being able to help my students. That's why I made the move from industry to academia. I've still always kept one foot in industry. I'm a startup advisor and I'm an industry consultant and have been for 15 years. I started my consulting practice back in August of 2010. It's exactly 15 years this month. I've always kept one foot in industry because I think that helps a lot when I can bring my industry experience into the classroom and be able to share with the students how things are really done. But I'm an educator at heart, first and foremost. I'm a teacher scholar. That's the way I present myself, is that my research is very much informed by the demands of my students. Everything I do professionally is with the interest of making sure my students are well prepared, making sure that I know what the most important skills are that are in demand and that I'm training my students appropriately so that when they do go to market and they're looking for a job and they're interviewing, they are able to convince the employer that they will add value from day one. And so what gets me out of bed in the morning with all these different hats that I wear now, of course, the most important hat that I wear is dad. Everything comes back to my kids. At the end of the day, can I create a future for them that's bright? And so beginning and end of the day, it all starts with my kids, my biological children. But professionally, what gets me out of bed in the morning and what really motivates me is being able to support the students that come through our Master of Finance program each year at University of California, Irvine. They take my undergraduate class in financial institutions every fall. And a handful of Ph.D. students that I work with, how can I best prepare them to be successful, to basically carry the torch? Because eventually I'm going to be gone, you're going to be gone. So what's the legacy that we leave behind, right? It's through our children as through our students. And that's what I'm trying to do right now, is help to pass that torch so that all of the knowledge that I've accumulated over my career as a consultant, as an advisor, as a researcher, as an educator, I'm able to share with my students so that they can go and create something new, create something better, and just add value.
And I think that's beautiful. And it happens to be correct that, you talked about regulators regulating by looking in the rearview mirror. And I think a lot of us recognize the same about education, which is there's a tendency to teach looking back as opposed to looking forward, which is probably why you, of all people, were willing to take on the project of writing a textbook, a book about fintech that required going back to chapter 40 times because it kept evolving in real time. It's a hell of a lot more work, but to be grounded in the present and looking out to the future is really the only way to move the ball forward. And so you ought to be applauded for it. That's why I'm so grateful that I've gotten to know you and that we're having this conversation today. On the way out, as you may know, I've taken to asking a series of questions to my guests, questions that bathed my youth in Paris from a TV show on French television. So are you ready for a rapid fire set of questions? And please interpret these questions as directly or metaphysically as you see fit. What is your favorite word?
Opportunity.
What is your least favorite word?
No.
What is your favorite drug?
Caffeine.
What sound do you love?
My kids' laughter.
What sound do you hate?
Silence.
What's your favorite curse word?
Can I say it on here? I'm from Jersey. It's fuck. Get the fuck out of here.
I like it. This is a little awkward asking to a fintech expert, but who would you like to see on a new banknote?
On a new banknote? Probably Barack Obama.
What profession, other than your own, would you never want to attempt?
Chef. I'm a terrible cook.
If you reincarnated as a plant or an animal, what would it be?
Butterfly.
I love these answers. They're all so beautiful.
Yeah.
Are you ready for the last one? If God exists, what would you like to hear him say when you arrive at the pearly gates?
You did well.
Well, I think you're doing fantastic. So in the spirit of continuing this conversation and pushing the knowledge forward, if people want to read the book, if people want to follow your career, what's the best way to go about it?
Follow me on LinkedIn. That's probably the best way to follow me. I'm also on Instagram, but that's more for personal stuff. My sneaker collection and my kids' basketball and stuff like that. If you're into sneakers, you can check out my kicks on Instagram. But the best way to follow me is on LinkedIn. You can also check out my UCI page. The Paul Mirage School does a great job of promoting my work.
How do you get the book?
It's available on Amazon or Barnes & Noble. The good thing about Amazon is they've got those algorithms that kind of bump me up in the rankings. So I do prefer when people buy it on Amazon just for that purpose.
Well, Michael Imerman, it was a fantastic conversation.
Yeah, my pleasure. Thanks for having me, Jonathan.
This podcast is for entertainment and education only. Nothing here is financial advice. Treussard Capital Management is a registered investment advisor. Please visit our website, www.treussard.com, for additional information and disclaimers.